They lost everything. Not paper losses. Not a bad month in the stock market. Everything. Factories, companies, homes, reputation, influence. Some of the richest people in history have gone completely broke and then quietly rebuilt fortunes even larger than the ones they lost. Which raises a strange question. How? Because statistically, most people never recover financially after a major collapse. A bankruptcy, a recession, a failed business, a debt spiral. For most people, those events permanently change the trajectory of their lives. Yet somehow, certain people fall from the top, hit the ground hard, and climb back faster than everyone else. Donald Trump lost billions in real estate debt during the 1990s. Howard Schultz was pushed out of Starbucks before returning to rebuild it into a global empire. Steve Jobs was fired from Apple, the very company he founded, and came back to build one of the most valuable businesses in human history. Elon Musk nearly ran out of cash multiple times during Tesla and SpaceX's early years. In 2008, both companies were close to collapse at the same time. And here's the uncomfortable part. Most of them did not rebuild because they worked harder. That's the story people like to tell afterward. It sounds fair, simple, motivating. But reality is stranger than that. Because wealth at high levels behaves differently from money at normal levels. Once you understand that difference, you start seeing why some people can lose everything without really losing their position inside the system. And position changes everything. But we'll come back to that. First, we need to talk about something most people misunderstand about rich people in general. Most people imagine wealth as a giant pile of money. It usually isn't. The ultra-wealthy rarely keep most of their wealth in cash. Their wealth exists in ownership, equity, influence, networks, access, brand value, credit, which means when they lose everything, they often lose visible wealth while still retaining invisible advantages. That distinction matters more than most people realize. Imagine two people losing $10 million. One is a lottery winner with no network, no business experience, no investor relationships, no systems. The other is someone who spent 20 years building companies, raising capital, understanding markets, negotiating deals, and developing influence. On paper, both people lost the same amount. In reality, they are not starting from the same place at all. One lost money. The other lost assets, but kept capabilities. That changes recovery speed dramatically. This is why many wealthy people rebuild faster than ordinary people after collapse. Because the real engine of wealth was never just the money itself. It was the infrastructure around the money. Relationships, reputation, access to capital, knowledge of systems. And perhaps most importantly, the ability to take large risks repeatedly. Most people can only survive a few major financial mistakes before they're permanently damaged. The rich often operate differently. They are protected by asymmetry. Here's what that means. When an ordinary person fails financially, the consequences are immediate and personal. Rent becomes a problem. Food becomes a problem. Debt collectors appear. Credit scores collapse. Failure reduces future opportunities. But at higher levels of wealth, failure can actually create future opportunities. That sounds absurd, but watch closely. In the corporate world, surviving failure itself becomes proof of resilience. Investors often trust founders who failed once more than founders who never tried at all. Why? Because large-scale business failure teaches things success hides. Operational pressure, cash flow fragility, debt structures, investor psychology, market timing. Most business education doesn't come from success. It comes from near disaster. There's an old Silicon Valley phrase, fail fast. People repeat it so often, it sounds motivational. But underneath it is something darker. Modern financial systems quietly reward people who can survive repeated failure long enough to eventually capture massive upside. That creates a strange imbalance, because survival itself becomes a competitive advantage. And wealthy people survive failure more easily. Not because the universe loves them, because systems do. Take bankruptcy law. Most people think bankruptcy means financial death. Historically, for wealthy industrialists and corporations, bankruptcy often functioned more like strategic restructuring. Airlines do it. Real estate developers do it. Large corporations do it constantly. Debt gets reorganized. Assets get protected. Operations continue. The average person sees collapse. The system often sees reallocation. And once you realize that, you start understanding why some wealthy people appear almost impossible to permanently destroy financially. But there's another layer most people miss entirely. The rich rebuild faster because modern economies heavily reward ownership during recovery periods. This happened after the 2008 financial crisis. Millions lost homes, jobs, savings. But after central banks flooded markets with liquidity, asset prices exploded upward over the following decade. Stocks recovered. Real estate recovered. Tech valuations surged. The people who still owned assets or could quickly acquire them during panic became dramatically wealthier afterward. This creates one of the strangest patterns in capitalism. Crises often destroy the middle class while strengthening large asset holders. Not always intentionally, but structurally. Because downturns reduce competition, lower prices, and create opportunities for people with liquidity or access to credit. That's why some investors quietly become more aggressive during economic panic while everyone else retreats. Warren Buffett once said, "Be fearful when others are greedy, and greedy when others are fearful." Simple sentence, but psychologically brutal to execute. Because buying assets during collapse feels terrible in real time. In 2008, people thought the global financial system itself might fail. In 2020, entire cities shut down. At those moments, survival instincts dominate logic. Most people pull back. The wealthy often lean forward. Not because they're fearless, because they understand something important. Recovery phases tend to reward ownership disproportionately. And ownership compounds. Now here's where things get even more uncomfortable. Sometimes the rich rebuild not because they avoided risk, but because they mastered narrative. This part rarely gets discussed openly. Markets are emotional systems. Investors don't just buy numbers. They buy stories. Vision, confidence, momentum, identity. Elon Musk understood this exceptionally well. Tesla survived years where many analysts believed bankruptcy was inevitable. But Musk consistently maintained investor belief in a future large enough to justify continued capital inflows. That belief kept the system financing survival long enough for reality to eventually catch up. This happens more often than people think. In high finance, perception can temporarily function like oxygen. Without it, businesses suffocate before recovery arrives. With it, struggling companies can survive far longer than logic alone would predict. Which raises another uncomfortable question. How much of wealth is actual value, and how much is confidence? The answer is probably more psychological than most people want to admit. Now zoom out further. What does all of this mean for ordinary people watching from the outside? It means the game is not only about making money. It's about maintaining position during volatility. And position is built long before crises arrive. Skills, networks, ownership, reputation, access to information, access to capital. Those things matter far more during collapse than motivational slogans ever will. This is why two people can experience the same recession and emerge in completely different financial worlds afterward. One spends the next decade recovering. The other quietly acquires assets at discounted prices. And over time, those differences compound into entirely different lives. But there's a deeper irony hiding underneath all this. The systems that allow wealthy people to rebuild quickly are often the same systems that make recovery difficult for everyone else. Cheap credit flows upward more easily than downward. Asset inflation disproportionately benefits owners. Risk protection increases with scale. And the larger the financial system becomes, the more powerful those effects often become, which creates a paradox. Capitalism depends heavily on risk-taking and creative destruction. But over time, large players become increasingly protected from destruction itself. Too protected, and the system becomes stagnant. Not protected enough, and instability spreads everywhere. So the balance constantly shifts, invisibly. And maybe that's the real lesson hiding underneath these stories. The rich don't rebuild because they're superhuman. They rebuild because modern financial systems reward certain positions, behaviors, and forms of ownership disproportionately during recovery cycles. Money matters, but systems matter more. And once you understand that, failure starts looking very different depending on where someone stands when they fall. Because for some people, losing everything is the end. For others, it's just another phase before the next expansion begins.